Hello ACCA Performance Management students. In this video, let's tackle question Caroline Co. parts A and B together. Now, if you have not tried this question yet, I highly recommend hit pause, go into the practice platform or the study hub, find this question, give it a try on your own, and you will get much more out of the video. Team, I'm in the exam platform. We've got two parts of the question here, A and B. We look at the verb. We've got to prepare a profit statement for two divisions and the company as a whole under the current transfer pricing arrangements. We've seen this type of question in the past, so I am ready to rock. Now I check part B. The verb is calculate the effects on the profit of each division and the company if a different transfer price is used. And then part B2, we've got a third variation on the profit statement if we close one of the divisions. So we've got a lot of numbers to crunch. They gave us a spreadsheet. I am stoked. I'm happy to rock this question. Let us read what's going on here. Well, we've got a decentralized company, so managers have autonomous decision-making in the two divisions. We've got the radio division, and we've got the packaging division. Radio division makes radios. Packaging division makes boxes, and the packaging division sells all their boxes to the radio division. Ooh, they might be missing out on some opportunities there in the open market, but not relevant for our task at hand. Now, we've got a pretty simple table here with information. Usually, or at least in the past, this has been a more complicated table. So I'm liking this question so far. We've got an external market price for the radio division. We've got some variable costs, some fixed costs, and some units. Now, we do not have the complications of a maximum capacity given to us. So, liking this question. Current transfer price for the boxes is based on the full cost. So, guys, we're going to have to get a variable cost per unit, a fixed overhead cost per unit with an overhead absorption rate, and then add those up for a full cost, multiply by 1.2 to get that marked up price. Now look at this. We get an external company offers to sell us boxes for $4 a box. And we've got two situations here, two possible responses. Let's ask packaging to lower the price to $4 a box. Or let's just close that division and buy all of the boxes from the external supplier. Last but not least, we learn that if we close the packaging division, we don't clear out all of the fixed costs. We only reduce our fixed costs by $20,000. Okay, not the most difficult performance management question I've ever seen, but nevertheless, it's a little tricky. So let's now go through it. I'm going to label my work for the marker, everything I'm doing, making their life easier. And first step is to get the current transfer price. You can double click on this column separator to auto enlarge it right there. And to do that, we need a variable cost per unit, fixed cost per unit. Then we can get the total cost. And then we can get markup at 20%. Guys, don't worry about these abbreviations. If the marking team understands what you are writing, they will give you credit, and these are common abbreviations for these terms. We want to save time at every opportunity. And in the scenario, we read that the variable cost was $1, and we can see that the annual fixed costs are 80,000, annual units are 20,000, so the fixed cost per unit will be 80 divided by 20, or $4 per unit. The total then, add those up with the handy-dandy sum function. Of course, you can also do that mental math. And we get 5. The markup then, we use the equal sign. We multiply this by 1.2, and we get 6. Let's now do a little light formatting. Wouldn't get any credit for this, but let's just be professional in our presentation. When we're doing cost per unit, it's nice to round at least to the cent. So there we go. $6 transfer price. Not so bad. Now, we need to make a profit statement, and we need to show profit for each division. So we've got the packaging, we've got radio, and then we've got group or Caroline, however you want to write that is fine. And they want us to break things internal, external. So let's do this. Internal sales, external sales, and then we can do a total sales line. So that covers our sales. Now I'm going to skip a line to start my costs just for my own orientation, just to make it clearer for me, to help me avoid any spreadsheet errors. And the first cost we'll have is that internal transfer. And then we have the variable costs. We have the fixed costs. And if we subtract those costs from the sales, we will have a profit line. Not so bad. Now, you could put that contribution line in there. There wouldn't be a mark for it. Usually there's no mark for that. I'm going to keep things really simple, really quick. Don't need contribution here. I'm not making any decisions. And the question is asking for profit. So I will give them what they are asking for. So nice template. Always do your templates first. If you don't have a template, it's going to slow you down. So guys, we see over here 20,000 in sales. We've got a price of $220 for the radio division. We've got these variable costs of $1 and $120. Fixed costs of $80, $500,000. So first thing I'll do, I'll show the marking team that I'm going to be working in some countries' dollars, and I'll be rounding off to the 1,000. So notice I'm using this single parenthesis mark to show that something is text rather than a number. So there we go. Internal sales, that will be equal to 20 multiplied by the 6. External sales, that will be equal to the 20,000 units multiplied by 220. And now I can quickly do a sum function. Yes, I know there's a faster way to do it. I'm just so used to doing this. It's just instinctual now. Copy, paste. And now let's be careful for the group. We only want things that are external. So that's equal to that. And then the external sales will only be the external part, what the radio division does. Guys, easy peasy. Now, the fun begins with the costs. So guys, the internal transfer will be equal to the internal sales, and I'll just put a negative sign in front to show that it is now negative. One division's cost is one division's revenue. And we saw that the variable cost was $1, so 20,000 times 1 is 20,000. Variable cost for the radio group, that's going to be 20 multiplied by the negative 120. That's that variable cost for the radio division. Now we need to bring in those fixed costs. So we got 80,000 for packaging, 500,000 for the radio group. Guys, making quick work of this. So, last thing to do is calculate the profit. I'll put an underline sign right there to show that the next thing happening is a total. Now I'll use the sum function again, and I will grab those total sales and those costs, copy the formula over, and we're almost done, guys. Let's finish up the group. We only want the external items, so again, that sum function comes into play. I'm grabbing the total of these rows, copying that formula below. And last but not least, copy that total formula there, and we get 1,400,000. That is the correct answer, team. And again, a little formatting here. Can round this off and looking nice. Maybe we don't need all of those zeros. That precision is too much in this instant, so we can drop the zeros. And my table just looks beautiful. Guys, that is part A to the question. Now, the fun really begins in part B, because all they want us to do is tweak this table so we can save up so much time here and then apply this time saved, to some more difficult problems, maybe in section A or B. So let us come down. Let's label this part B1. And we will now execute a tactical copy-paste. Just bring this down. And now all we have to do is change out the internal sales, 20 multiplied by that transfer price of 4. Everything else stays the same. So friends, those were the easiest 4 marks I've ever earned in any ACCA exam ever. So what's the implication though? Well, look at that. By changing the transfer price, the group profit stayed the same, didn't it? But the packaging manager now makes a loss. Packaging manager will not be happy, and one guy's loss becomes the other guy's profit. So the radio division earns a higher profit with that lower cost. But again, right, the group stays the same. Okay, now B2. For B2, we're going to close the packaging division, and we're going to just use the external vendor. So now we have to change our spreadsheet a little bit. So we get no external sales, no variable cost, but the fixed cost, it said in the story here, the fixed cost will only save $20. So the negative 80 goes to a negative 60. And now we can relabel some of this. The internal transfer can now be external purchase, okay, of box, or let's just call it external box. And that's going to be equal to the 20,000 units times a negative $4 per box. And we have to fix our formula here because the group will now be incurring that 80. That's an external. So guys, look at that. The profit went down if we used the external vendor. So that's part B2. Ladies and gentlemen, there you have it. Question Caroline Co. parts A and B. First we did the transfer price. Then we made the profit statement. Then we adjusted the profit statement as requested. I hope you found this debrief useful. If you would like to check out my solution to part C, please look at the description of this video, head over to my website, and you can check out all of my options to view all of my PM videos. Guys, good luck on your upcoming exam.